My name is Navroop Sahdev. I'm a research associate at the Center for Blockchain Technologies at University College London. We are a university-based neutral think tank where we pool top scientists, practitioners, regulators, and technologies working in the space and bring them together to explore synergies in an unbiased manner. I'm also the member of Koala, which is a coalition of automated legal applications. It's a spin-off of the Harvard Law School, the Berkman Klein Center for Internet and Society. Again, fortunately or unfortunately, I work very closely with the lawyers, so I know the struggle is real. I'm also the co-author of, had the pleasure to write the business chapters of Hyperledger's Blockchain for Business online course. The last I checked, we had around 20,000 people who are taking the course. Apart from that, my day job consists of building a trading platform for crowdfunded equity for non-accredited investors, starting with Reg CF and eventually opening up to Reg A and Reg T. With that aside, I'm going to ask the panel to quickly introduce themselves, a little bit about their background, and also what they're working on right now and how that relates to blockchain in particular, which is really what we're here for, right? All right.
Shall I start?
Go ahead.
Sure. So my name is Peter Duggan. I'm responsible for ComputerShare's private markets business. And the private markets business at ComputerShare is basically record keeping of shareholders / investors in alternative investments. ComputerShare, you may know, is also a record keeper for 70% of the Dow, very large public companies, the largest transfer agent in the US, but we're also providing the same type of record keeping of shareholders and investors for other types of instruments. And that's why, we'll get to the discussion on ICOs and what we're doing with ICOs. Most of the companies that we work with raise capital under one of the exemptions from full SEC registration. So whether it's Reg A plus that you've heard a lot about, Reg CF or Reg D, even a little bit of Reg S. Now, talking about ICOs in particular, we definitely feel that they are a revolutionary financial instrument, but they are an instrument. And we have to separate instrument from the technology of how the instrument is used, right? So, we've heard a lot about blockchain, and blockchain is absolutely a way in which you can record keep investors of the tokens. But there are other ways that record keeping of the investors on the tokens can be done. It can be done sort of in the traditional shareholder record keeping environment that has worked for many years. So ComputerShare is comfortable doing both. We worked on the first blockchain security for a public company, and that was Overstock.com's preferred offering, which was done on the T0 platform. But at the same time, we're talking to some ICOs right now who want us to record keep the tokens in the same way we record keep equity for public and private companies. So independent of blockchain, independent of smart contracts. And maybe when we talk a little bit later, we could talk about some of the pros and cons of doing it in a blockchain environment versus doing it in a non-blockchain environment.
Sure. Thanks. Yeah, Shone.
So my name is Shone Anstey. I'm the executive chairman of Blockchain Intelligence Group. We're out of Vancouver, Canada. We trace, track, and monitor Bitcoin and cryptocurrencies. We work with law enforcement here in Washington, D.C. and other agencies around the world. We are very pro-Bitcoin. We see regulations as one of those things that allows Bitcoin to be accepted. Within that vein, we met with regulatory agencies in Canada, many large banks who wish to engage in cryptocurrencies. We have two products that fall into those categories. We have one called BitRank Verified that risk scores every Bitcoin address in the ecosystem and updates it every 10 minutes based upon its usage and creates a very seamless and a quick way for them to have AML and risk compliance at the gateway before something comes into their environment. We've been in tech. I've been in tech for 20 years. We have a team that's been around in cryptocurrency since 2011. We're a team of 15. We've just added another member on who is involved with artificial intelligence as we start to apply these algorithms to solve the AML and the risk issues using technology. Because as in our industry here, we talk about regulations, but technology will always outstrip regulation. That's the entire point of technology. It's always moving at a faster pace. So we feel the real solution is, yes, regulations are there, and we're seeing it adding trust and people understanding the space a lot better. and helping bring it mainstream, but using technology to actually allow agencies, banks, financial institutions to engage in cryptocurrencies themselves, and Bitcoin, which really represents the public blockchain, and it really represents the most important innovation. Ethereum as well within there, but Bitcoin really represents the most important innovation. I'll get into a little bit later what we really see Bitcoin as the next generation of the internet. It's the ocean that's coming in and is far bigger than most people actually realize.
Thank you. My name is Roman Kaufman, and I'm a co-founder at Holco Projects. We develop special project with smart contracts based on Ethereum platform. We develop new level of marketing. As you know, performance marketing is a marketing where you can pay only for result, not for click, not for views, not for anything, but for result, for sales, for install. And now we have a very strong developers team, and we create some system. Besides, I'm a co-founder of one of the biggest blockchain community in Russia, is IBCG. And we have a lot of smart developers, smart marketologists, and now we provide blockchain ideas around the world, and I'm very appreciate to be here and communicate with you. Thank you.
Great. Thank you to all the panelists. So I want to start by one of the points that Shone mentioned here, where regulation is always catching up with technology. I think we hear this in every single conference, and for a conference like this, which is so focused on regulation. So, Shone, I want to ask you, can you give us some concrete examples of where regulation is, or the space of RegTech actually has done some things, where regulators are doing something with blockchain technology, and how financial institutions, as the second part of the question, can sort of like catch up with this?
Sure. Well, certainly just law enforcement themselves getting a handle on cryptocurrencies used on the dark web. We have software that assists with them, and we work hand in hand on certain cases around the world. That alone, I think, in our industry, in the Bitcoin industry, people originally thought, well, this is great. This is the free markets at work. We have all these people, selling X, Y, Z and using Bitcoin. And criminals will always go to what is easiest. They're in a high-risk business. They're either going to make a lot of money, go to jail, or get killed. And so they'll always take what is cutting edge, and Bitcoin is cutting edge and a very useful service. But as I like to tell people and my libertarian friends, these people on the dark web, they're not your friends. They are not friends of Bitcoin, and they're not friends of crypto. They will move to whatever is next once they've killed your dream. The reality is, so as we continue to see it being cleaned up, we've seen dark markets like Alpha Bay and other ones get shut down by a lot of great law enforcement work through the IRS and Homeland and FBI and that reach around the world, and it's improving investor confidence as they see that there are ways for to weed these kind of bad actors out. You'll never totally eliminate it, but we have to have ways that improve investor confidence. And so that's one thing we've seen on the law enforcement side. On the regulation side, we're seeing things up in Canada where there's ICOs that are being approved for public companies. There are ICOs that have been approved for private companies. There's a number of hoops for them to jump through, but it's creating a framework for people to go with, to work within and feel comfortable as they start to participate in it. And we look at sort of the ICO market, and we had the option of doing an ICO for ourselves. And we chose not to. We actually just filed a listing statement. We went with sophisticated investment firms out of Toronto for our backing, and we hope to be up and trading fairly soon. One of the reasons we avoided the ICO market is because some of the ICO platforms that are out there, one of them in particular was really trying to work us hard to go with them. We said, look, we're going to use our BitRank verified. We're going to ensure that none of the money coming into our ICO is going to be coming from the dark market. Mm-hmm. And then there was strange silence on the phone for a few seconds. Then the CTO on this call popped in. So, well, why would you want to do that? And that was the end of that phone call. So this is where there's something to be said for traditional markets and regulation, and coming in that gives the person in the street that confidence that the government is there, and there are certain things the government does very well, and we shouldn't just simply discard that. I think there's going to be a hybrid move between the models, and it'll actually propel it much further forward. As we look right now, 95% of the ICOs are going to fail. They have nothing. You look at them, and the irony is with these ICOs is Bitcoin blockchain was born during a time when they had the housing crisis in 08 and 09. And it was all about creating clarity in the financial institutions. And now you have all these ICOs where there's no board of directors, there's barely a white paper, you don't know where the funds are going to, there's no quarterly reports, there's zero insight into what's going on in the company,
Sure.
which is the complete opposite of what blockchain is all about.
Great. Yeah. Thank you, Sean. So I also hear that you're a Bitcoin purist, if I may use the term. So this is where I want to open up the conversation, something we have been missing so far, not just confined to the Bitcoin blockchain, which is a blockchain, and the Ethereum use case that we heard from Roman, but also to plenty of other chains that are out there. Most of the people here in this room are working on the financial services sector use cases. And I would argue that most of the most of the financial institutions do not want to be on the public blockchains. They instead want to have permissioned ledgers where they know their counterparties and can hence reduce the counterparty risk, right? So we have implementations, saying some examples like the Hyperledger's permissioned blockchains or R3's Corda, which has been built exactly to keep in mind, the needs of the big banks, for example. So I want to throw this at the panel, and maybe each of you take a quick round on what do you think about the private chains, a topic we haven't covered so far. So,
sure. So just taking into consideration where Computershare plays into this space. So we're not involved in the capital raise, whatever currency, whatever. Whether it's Bitcoin, Ethereum, it's after the capital has been raised and the tokens are issued, record keeping the investor of those tokens. Okay, so it's slightly different maybe than some of the others on the panel. But in record keeping, not the most exciting thing in the world, but in record keeping the owners of the tokens, there are a number of things that happen that are really important that whether it's a smart contract is written to understand every permutation of record keeping of assets and securities, or you need to have just a good partner who understands how these types of assets do get transferred. And I'll give you an example. And the laws are constantly changing, so I'm not even sure from a smart contract standpoint how you can keep up with the laws, how you can keep adjusting the contracts that are already written. But a good example would be we get involved, we're record keeping the shareholders of the tokens, and someone dies. The process by transferring that asset and understanding the regulations upon transfer on death, what type of paperwork is needed to support that transfer. Or there's a divorce, somebody has claim over the asset. These things aren't really proven out yet in the token world, but will have to be very soon. And even if all of that is written into a smart contract, the regulations are constantly changing on how to interpret these. So again, having a party that has experience in understanding what is an industry accepted standard, what type of paperwork is involved to affect that transfer versus letting that transaction happen on its own, we think is something very important. And I'll give a third example of why, again, this gets a little tricky as the ICOs are evolving and record keeping of tokens is evolving, either having it in the blockchain or having it record kept in some other environment. Every state has rules on abandoned property, right? So after a certain period of time, if an investor is not taking active engagement over their asset, that property needs to be turned over to the state of residence of the investor. Every state is different. And the rules of what abandoned property means is different as well. So even though you might have an electronic security, the way the law is written might still not matter. If they haven't taken some active engagement over the property, that property can be deemed to be eligible for escheatment. That's an area where I'm not sure the smart contracts will always know how to handle that. So I didn't exactly answer the question because I'm not from the frame of reference you're asking, but I'm just sort of throwing out there for anyone in the room just these concepts around if these are securities and if they have investors, there are a whole series of rules and regulations that may not be addressed through the current technology.
Sure. Roma, would you like to have a...
Yeah, I have another idea, but I know there are a lot of companies who use private blockchain. And I think in the near future, private blockchain doesn't exist because we are in transparent world. And in near future, we will check and we will connect with other public blockchain because our life be more transparent. I think it's very good for us because, for example, let's see on a state where government use cryptocurrency or token for all payment. In this case, we can see all payment and all transaction for our taxes for something else, and we can't hidden a lot of transaction and spends. That's why it's more transparent and it's more useful for us. And I think future will be in transparent blockchain.
Yeah, that's an interesting perspective. I think coming from a more business point of view and as an economist, I'd argue that a lot of traction, Bitcoin has been around since 2008, but suddenly the whole world was talking about Bitcoin and blockchain really happened when the financial services industry started to look at it, right? When the money started pouring in and realizing that blockchain, going beyond what an anonymous person wrote down and implemented the protocol, there are so many use cases that we can explore. But I think it's good to have different perspectives. All right, so moving on, again, I want to broaden this up and get some of the perspectives of the panel on what they think are use cases beyond simply finance. We heard healthcare, but there are a ton of other exciting use cases that if the panel can briefly touch upon for our audience.
It really depends on what you're looking at for blockchain, because when we talk about blockchain, we talk about the public blockchain. And so private blockchains can be amended to any kind of system that needs a database where there's some kind of, not just immutable ledger, but we have to remember private blockchains represent auditability. That's the whole point of it. You can still have somebody trying to put fake data into your company stuff, but you have an audit trail going back to it. You know where it came from. The public blockchains, on the other hand, with the advanced cryptography, Bitcoin itself, what is Bitcoin really? We talk about its payment, it's this, it's that, the other thing. What it really represents is a protocol layer change to the internet itself. And every 20 years in technology, you get a protocol that changes everything. So in the 70s, you had Unix and CPUs come out, and within 10 years, you had Apple and Microsoft born, consuming this protocol, becoming the giants that they are. In 88, you had the web born, and you had TCP/IP, which the internet as we know it born. And within 10 years, you have Google and Facebook and mobile computing. Bitcoin itself represents a secure trust and transaction layer to the TCP/IP stack of the internet itself. It represents a secure trust and transaction layer of the internet. This is a protocol layer change. You will not see another one for another 20 years. And when you start to think about Bitcoin, not as payment, but as this protocol layer, a trust transaction layer of the internet, you start to understand all the different things you're going to be able to do with it. It creates nearly the near perfect layer to do banking. And so the real risk for Wall Street and regulation and banks is not whether they should engage in Bitcoin, whether they should engage in crypto. They have to engage in it. It's the new trust and transaction layer of the internet itself. How long do you think it's going to be until Silicon Valley wakes up and understands they have the perfect protocol that's layered on top of TCP/IP, the protocol they are already the masters of, and they are the thoroughbreds of this industry. And Silicon Valley is going to get into the banking industry within 5 years. And they're going to use the Bitcoin network to do it. And they have the army of developers to do it. They got the war chest, and they have last mile solutions right to mobile devices. So the real question is, how long is it going to take until banks get in there? What do banks need to engage in cryptocurrencies? They need regulatory sandboxes so they can operate in and not feel that they're under scrutiny. They need to themselves create sandboxes internally. They need to create mindsets like Silicon Valley where they can adapt quickly, fail quickly, and pivot to do new platforms within their bank until they understand and get the solution correct for their own industry. Right now, the banks are in the pole position. Why? They have brand. They have reach. They understand banking. More importantly, they have customers. But those sands will erode away as this new medium of change gets layered on top of TCP/IP, and as Silicon Valley continues to wake up. And you just have to look at Amazon back in the day. They embraced TCP/IP, they embraced the internet itself, and all they had to do is keep investing in their own company, stay upright long enough, and look how many companies they've knocked off along the way. And that medium of change, so you're going to see other pure play crypto banks come up there or Silicon Valley type monsters who will embrace this medium of change because they're fearless about it. And within 5 to 10 years, they'll be knocking off Wall Street banks. So.
Sure. Other perspectives from the panel?
And guys, I would like to add that since of this January, Bitcoin will test own smart contracts. It's very interesting action because we know that Bitcoin the most popular cryptocurrency right now, and if they start first smart contract, it will be something amazing.
That's well said. That's called Rootstock. That's called
Yeah.
Rootstock in It's an excellent platform. You can take
Thursday,
any Ethereum contract. We're partnered with Rootstock. We know the guys well. We run part of the network. Any Ethereum contract you'll be able to run on Bitcoin. And you'll take that vast computational power that Bitcoin has around the world and that stable network and to be able to process contracts. And within that new network, you're going to have sidechain pegs that allow you to do microtransactions and some Visa level scaling within the next 6 to 9 months. So the capacity is coming and the technology is there. And so these.
Sean, can I ask a question?
Yes.
When you say that Silicon Valley is going to get involved in banking, can you just be more specific? Do you think these are going to be layered into existing companies like a Google, an Amazon,
Yes.
Facebook? Okay, so
I guess it as existing companies, and you'll also see a new pure play crypto bank, the Amazon of our time, get in there and basically start from scratch. Maybe it's Coinbase, maybe it's another, I don't know. And they will embrace this medium of change. They will stay upright long enough, and they will have immediate last mile solutions to everyone around the world, everybody on their mobile phones and all their devices. And so it is really, when you look at the Bitcoin network as a new layer to the internet, a new protocol layer change, it's going to be huge.
Sure. We'll take the rest of the questions towards the end of the panel discussion.
My apologies.
I was just going to make one comment on, especially with the comment around banks. So ComputerShare is not a bank, but we play a role similar in that we're an independent, sort of trusted third party for financial services instruments. And I think in that capacity, there is an expectation that these kind of trusted third parties might be able to keep some control around the blockchain, maybe different than a public blockchain. So as I was describing before, some of the special nuances of processing securities that may not be able to be fully handled either through smart contracts or fully on the blockchain. I should have added that you were asking the question specifically on private versus public. I think there is a place for private blockchain with regard to these trusted intermediaries, at least initially, as the market is moving forward, to give investors confidence, to give any intermediaries in the market confidence. And so we're sort of on the side of private versus public, at least initially.
Great. So, okay. So moving on, I want to talk a little bit about the implications of this new technology, or I should say distributed ledger technologies, on how we think of value as economic beings and how we measure value in the society. With the ICO phenomena, I would argue the tokenization of the economy as we call it, is really leading us to rethink the way we perceive and measure value. So maybe starting with Roman, who's the economist here, we'll have some perspectives from the panel.
Yes, I think Bitcoin is most important for us, and John's latest looks like we are living in some countries who print money, but Bitcoin has deflational model, and every day our countries print a lot of money, but Bitcoins is decreased because we have deflation model, and some of ours our hardware doesn't work or something else, and we can store our private key. That's why for use this big print of money, we should, I think that it's a new generation for every financials, because now we go to the new level of communication, and it's a transparent world. It's a time where you can do and you can send all of them, because if you want to send some money from one company to other company on Christmas, you can do it because you have a holiday. But sorry for my English, but I think it's the future.
Yeah, definitely future. Regulation. You're the regulator.
Yeah, well, I wish. Yeah, no. Unfortunately, no. I would say, anything of value that is a different asset class is good in that, from a diversification standpoint, right? It allows investors to, invest in a variety of different securities. And I say securities because we had this conversation. A number of people throughout the day have had the conversation, right? We take a pretty strong position that as a regulated entity ourselves, a registered transfer agent, registered with the SEC, that these ICOs are securities unless a really reputable law firm is willing to write an opinion that says it's not a security. So we always start working from that perspective, and we'll work with companies that are deeming it a security, and as such, we expect that it will follow either full registration or exemption from registration under one of the existing exemptions I mentioned earlier, Reg A Plus and the like. We also have a difference, not a difference, but we have a view that there is a difference between the ledger and the register. The register is a legal concept, particularly around equity, but other types of securities. And there's information that is maintained on the register, not only the name of the investor in the token, the number of tokens they own, when they bought them, what they bought it at, banking information, their social security number, because if there's a distribution of funds made, there may be backup withholding that needs to be taken, and IRS reporting. There's a lot of information, and not necessarily all that information needs to be on the ledger, and the ledger is what is in the blockchain. And so, it's a subtle nuance. It may mean nothing for many of the people here, but we think it's an important distinction in the market.
Yeah.
Sure, we have 1 more minute and we open for questions.
Great. So on the ICO front there, we really do see there's some value. One of the reasons ICOs was born is sort of the democratization of sort of finances. And we just have to look at our own fundraising over the last 2 years and where we raise money from friends and family, i.e. my pocketbook, and their other directors. We looked at high net worth investors, and we started going down the path of, how do we raise money from that? We had people come to us saying, hey, I'd love to put 5 or 10 grand into you, and they know lots about the space, but they didn't qualify. And so we had to go after high net worth investors. Some of them made money in the mining industry, gold. They knew nothing about what we did, and they were not a good fit for us, and we took a pass on many of them. So it took us a long time to find the right fit. But what I find really odd is these people here saying, well, I want to put a small investment into a seed round because I think it could be a 10-bagger, could do really, really well before it goes public, and they're not allowed to because they don't have the money. But the same government has no problem for that same person taking $5,000, going down to the casino and blowing it in a night, and they won't even track it. They'll just say thank you. So that's the kind of stuff you have to have some regulation where it goes across the board there. If you're gonna allow people to blow their money at casinos, when they can come in, and especially, and I think it was Vijay, a gentleman we met in London, had a great idea. He talked to recently. Some of these people are out there, and they're professors, they're teachers, they're in this industry for 15 years, tech or whatever industry they're in. They may be in biology, and they want to invest in a biology startup. Yeah, they have more expertise than half those investors in the room. Why shouldn't they be able to put a small amount of money into there? They are effectively a qualified investor. And so that's where you're seeing ICOs coming out, for that frustration that people want to participate in. They don't want to be last in line going, well, I can buy it once it goes public. Meanwhile, all the fat cats got in at, $1, and it's now trading at 10, and then they're in and out, and that's the way the market is. So, this is one good thing that the ICO market, I think, has done. And even though it does need regulation and it does have some issues, but the underlying technology, that's really...
Right. Yeah. I thank everyone and the panelists and for their perspectives, and we'll open the floor now for a couple of questions, I believe. Yes.
So, Shone, you seem to be a big proponent of Bitcoin itself. If I heard you correctly, do you think we're going to be doing our banking on Bitcoin 1.0 or some other kind of cyber currency going forward?
That's a good question. So a company like ours, we invest our money into Bitcoin and understanding that network, analyzing it, and we looked at other networks, and this is a question of where do we want to spend our capital. And we have to look at, say, why Bitcoin? Why is Bitcoin the biggest? Why is it represent next generation? And we actually looked at it mathematically. So what's the mathematical value of the Bitcoin network? How powerful is it? How many nodes does it have around the world? And not to get too technical, but we compared it to supercomputers, just to put it in layman terms, and said, well, you know, a supercomputer does 91 quadrillion floating point calculations. Your phone does floating point calculations. At the same point in time, not a one-to-one comparison, because Bitcoin does integers, but Bitcoin network at that one point in time is doing 91 million quadrillion floating point calculations. In other words, it'd take 100,000 supercomputers to match what the Bitcoin network is doing. So we now know it's this vast distributed computing network that is not going to be turned off and represents next generation computing. So that's how we looked at it and approached it and said, computationally speaking, this is next gen and it has first mover advantage. It has all the things lined up. It really does represent the protocol layer of the index protocol layer of the internet itself. Other networks like Ethereum, I own Ethereum. Those guys are amazing. They're probably the right team, very brash, young, think they can do anything, and they seem to be able to. But perhaps they'll be the Netscape of our time. This wonderful technology will find itself bled into other networks. It's already coming into Bitcoin itself, a more stable network and stuff like that. But I hope that answers your question.
But why would anyone with an Ethereum smart contract want to do it on Bitcoin?
Well, right now they'll be able to do it on both. So network stability, speed. The Ethereum itself is going to move to proof of stake, not proof of work. And right now you have a technique called merged mining on the Bitcoin network happening for rootstock smart contracts. Any Ethereum contract can run on it. And this is where that vast computational power will be able to help validate those contracts within a few milliseconds of mining a Bitcoin block. And so you get that vast computational power behind it, validating and helping process your transaction. So
why hasn't Ethereum caused the price of Bitcoin to collapse?
I don't know.
I actually want to jump in here and sort of answer your question here. Why Bitcoin is you're not able to run smart contracts on the Bitcoin blockchain because it's not a Turing complete language. That's the technical reason for that. And what that means is that the code can actually sit on the blockchain and execute. And the Bitcoin blockchain actually does not provide the functionality. People like Shone are actually looking at how to peg their blockchains. Is that how you're doing it?
Well, no, Rootstock is using it as a sidechain peg to Bitcoin.
Right, so it is a two-way peg,
It's
right?
a two-way peg.
So you run something on your blockchain and then use a Bitcoin blockchain to validate it, and then the output is then, again, registered back.
Correct.
But that is not happening on the Bitcoin blockchain. That is really something that the Ethereum blockchain came up with and sort of
Correct.
opened up the space.
Correct, yeah,
Just give them a
absolutely.
little bit of credit there.
Yeah, no, they've done an amazing job, and it's what they've done. The team's done very well. So the sidechain peg does open up other opportunities because you're going to see technologies called Lumino within the Rootstock network, which does Visa level scaling. 20,000 transactions and beyond. I think it starts at 2,000 and will scale up to 20,000 and beyond in terms of microtransactions. Lumino, Lumino.
Any other questions in the room?
Well, just thank you very much, by the way. Thanks for the panel. Sean and everybody else has just recently been quoted at CNBC.
Oh, right.
The article, yeah.
Oh, thank
they
you.
wrote it over there. And so grateful to have, thanks for coming in, all our panelists. You came a long way from the West Coast. And also, thank you very much over there.
Great.
Thank you, Sydney.
Thank you.
Thank you.
Thank you.